In 1911, the U.S. Supreme Court ordered what many believed was impossible. Standard Oil, the most powerful company in American history, was broken into 34 separate companies. The monopoly that John D. Rockefeller had spent decades building was officially over. According to a widely repeated story, Rockefeller remained remarkably calm when he learned of the decision. One popular account claims that he simply turned to his golf partner and said, "Buy Standard Oil stock." Whether those exact words were ever spoken has never been conclusively verified, but the story reflects the confidence Rockefeller reportedly had in the companies that would emerge from the breakup. Within just a few years, Rockefeller wasn't simply recovering. He became one of the richest individuals in modern history. Adjusted for inflation, many historians consider him among the wealthiest people ever to have lived. To understand how Rockefeller became even richer after the government broke apart his company, we first need to understand the business he built and how it became a monopoly in the first place. Oil money came fast, and almost nobody trusted it to last. Wells appeared overnight and dried up just as quickly. Prices changed without warning. Entire towns were built on speculation and disappeared when the boom ended. The oil industry expanded faster than its infrastructure could handle. Railroads became congested. Barrels waited for transportation that never arrived. Refiners bought crude wherever they could find it and sold it into markets that changed constantly. Delayed shipments drained profits at every stage of the business. While many companies focused on finding more oil, Rockefeller focused on refining. Instead of chasing new oil fields, he studied every step between purchasing crude oil and selling refined products. He searched for delays, waste, unnecessary costs, and inefficiencies. He improved refinery operations, reduced waste, standardized production, and treated every delay as a financial loss that needed to be eliminated. Small savings repeated across thousands of barrels quickly became enormous advantages. While competitors constantly reacted to shortages and price swings, Standard Oil became more efficient, more predictable, and more profitable. The company continued expanding because lower operating costs allowed it to survive periods that forced competitors out of business. Most oil companies operated like temporary businesses held together by urgency. Deliveries were late. Storage was unpredictable. Railroad schedules constantly changed. Rockefeller reorganized the entire system. Storage facilities were moved closer to refineries. Shipments were synchronized with production instead of being handled separately. Products left refineries already moving toward customers instead of sitting idle. Railcars spent less time waiting. Storage tanks emptied faster. Customers received deliveries they could actually plan around. Reliability became one of Standard Oil's greatest competitive advantages. The railroads faced problems of their own. Freight volumes constantly changed. Railcars often sat empty. Companies cut prices just to keep their networks operating. Rockefeller offered something they desperately needed: consistent shipping volume. Standard Oil could guarantee large, reliable shipments throughout the year. In return, railroad companies offered discounted freight rates known as rebates. These agreements significantly lowered Standard Oil's transportation costs compared with its competitors. Some agreements even returned part of the shipping revenue back to Standard Oil whenever competing refiners used the same railroad lines. As competitors lowered prices to survive, Rockefeller could lower prices even further while remaining profitable because his operating costs were lower. Every shipment also generated valuable information. Standard Oil learned where demand was increasing, which markets were slowing down, and where future opportunities existed. Lower transportation costs created higher shipping volumes. Higher shipping volumes strengthened relationships with railroads. Those stronger relationships produced even lower transportation costs. The cycle continued. In Cleveland, competition became especially intense. The city was filled with independent refineries struggling against unstable prices and unreliable transportation. Many owners stopped thinking about growth. They simply wanted to survive. Standard Oil entered this environment offering something few competitors could match: stability. Deliveries arrived on time. Prices remained more consistent. Customers increasingly preferred buying from Standard Oil. Rockefeller then approached refinery owners directly. Sometimes he offered cash, sometimes company stock, sometimes partnerships, sometimes continued employment within Standard Oil. Many owners accepted because years of uncertainty had exhausted them. Others resisted. But as neighboring refineries joined Standard Oil, independent operators found themselves with fewer customers, weaker railroad access, and shrinking profits. Often Rockefeller didn't need to pressure anyone. Market conditions did much of the negotiating for him. As Standard Oil absorbed more refineries, competing became increasingly difficult. Transportation became easier for Standard Oil and harder for everyone else. Losses that destroyed smaller companies became manageable for Standard Oil because of its size. By the end of the 19th century, Standard Oil controlled roughly 90% of America's oil refining industry. To many observers, the company appeared almost impossible to challenge. Then, everything changed. A journalist named Ida Tarbell began publishing an extensive investigation into Standard Oil. Month after month, readers followed detailed reports describing railroad agreements, business practices, acquisitions, and the company's enormous influence. The investigation spread across newspapers throughout the country. For many Americans, Standard Oil no longer looked like an exceptionally successful company. It looked like a monopoly eliminating competition. Public opinion began shifting rapidly. Rockefeller rarely responded publicly. Meanwhile, politicians, competitors, and newspapers increasingly portrayed Standard Oil as the ultimate example of excessive corporate power. Soon, the phrase trust busting became one of the most popular political ideas in America. Its goal was simple: break apart corporations that controlled too much of a single industry. President Theodore Roosevelt strongly supported greater government action against large monopolies. Eventually, Standard Oil became the government's biggest target. After years of investigation and legal battles, the Supreme Court finally issued its decision in 1911. Standard Oil was broken into 34 separate companies. Newspapers celebrated the decision as a victory against monopoly power. The company that had operated as one enormous organization for decades would now exist as dozens of independent businesses with separate management and separate shareholders. Many investors expected these new companies to struggle. After all, no corporation this large had ever been dismantled before. But something unexpected happened. As investors began evaluating each company individually, many of them performed remarkably well. Instead of waiting for decisions from one central organization, each company focused on its own strengths. Refining companies improved refining. Pipeline companies expanded transportation. Regional businesses entered new markets. Investors gradually gained confidence. Share prices rose. Capital flowed back into the industry. Most importantly, Rockefeller still owned significant shares in many of these newly independent companies. As their values increased, so did his personal fortune. Rockefeller eventually became one of the richest individuals in modern history. Many historians estimate that, adjusted for inflation, his wealth remains among the greatest ever accumulated. The breakup achieved its primary legal objective. Standard Oil no longer existed as a single monopoly. However, the pipelines, refineries, transportation networks, and business expertise continued operating through the newly independent companies. Many of those companies would eventually become Exxon, Mobil, and Chevron. The Standard Oil case became one of history's most fascinating business stories. It demonstrated that breaking up a corporation does not necessarily destroy shareholder wealth. In Rockefeller's case, ownership of multiple successful companies ultimately proved even more valuable than ownership of one giant corporation.